Welcome to the deep dive. Today, we're jumping into the premium jackup driller, Borr Drilling.
Yep, ticker BORR. And specifically, we're unpacking their Q3 2025 earnings call from, early November?
November 6th. And this wasn't just some routine update. This was, I think, a quarter of really decisive action.
It absolutely was. Management proved they could, execute on the operations side while at the same time tackling these two huge risks that were just weighing the stock down.
You're talking about Mexico and the sanctions?
Exactly. The payment problems in Mexico and then, boom, losing contracts because of international sanctions.
So our mission today is to unpack exactly how they managed that pivot. We'll look at the financials, the strategic restructuring they did, and then the bigger picture, the macro trends that are really heating up the market for 2026.
And just to set the stage, the sentiment coming out of this call was overwhelmingly constructive. I mean, they didn't just meet the numbers.
No.
They delivered a clean beat and showed a kind of commercial agility that I don't think the market was really giving them credit for.
All right, let's start with the headline numbers then, because they really do tell a story of solid execution.
They do. So Q3 GAAP EPS came in at 10 cents.
10 cents. And the street was looking for something like 7.5, maybe 8 cents. That's a huge beat.
It is. We're talking a surprise of 25 to 34%. And it was built on real operational strength, not some kind of financial trickery.
Right. Total operating revenues hit $277.1 million.
Which was, again, way above the consensus of around $261 million. That's a 6% beat on the top line.
And a pretty solid year-over-year increase, too, almost 15% compared to Q3 of last year.
And the profitability, I mean, that's where you see the leverage in this business. Adjusted EBITDA was $135.6 million.
That's a margin of almost 49%. So it's really impressive.
It is. And it flows right down to the bottom line. Net income was $27.8 million, which is just massive growth, something like a 187% increase from the same quarter in 2024.
Okay, but to really understand the quality of those earnings, you have to look at how the fleet was performing.
100%. Borr has one of the youngest, highest spec fleets out there, and it really shows. They had 23 out of their 24 rigs active.
And the utilization numbers were just stellar. Technical utilization at 97.9%.
And economic utilization, and this is the key one, the time they actually get paid for was 97.4%.
97.4. That is genuinely industry leading.
It is.
And for you, the listener, this matters because it means there's almost no slack capacity. When utilization gets this close to 100%, pricing power just completely shifts.
It shifts from the customer to the rig owner, and that's exactly what's happening.
And you could see that operational strength feeding directly into the balance sheet this quarter.
Oh, yeah. Their cash position just ballooned. It went from, $92 million last quarter all the way up to $227.8 million.
Now, part of that was fueled by an equity offering back in July, right?
That's right, about $97 million from that. But the end result is what matters. Their total available liquidity is now a really robust $461.8 million.
And from a cash generation standpoint,
Net cash from operations was $72.1 million. So after you take out their CapEx, you're looking at a free cash flow of around $38 million before any financing.
And that free cash flow, that's the money they can use to pay down debt, which, as we're about to discuss, is their number one priority.
Absolutely. So with that performance, management had no problem reiterating their full year guidance. They're still targeting $455 to $470 million in adjusted EBITDA for 2025.
And the visibility heading into next year looks great.
It does. They're about 85% covered for the rest of this year at an average day rate of $145,000. And looking ahead to the first half of 2026, they're already 79% booked.
That's a very comfortable position to be in.
Right.
It means they're not desperate when they go to negotiate the next round of contracts.
Not at all. They're negotiating from a position of real strength.
Okay, let's pivot to that strategic storyline, the big one, how they fix the Mexico problem.
Right. This was a major focus on the call. They basically re-engineered their entire exposure there. First, they cut the number of rigs in Mexico from 7 down to 5.
So just an immediate reduction in risk.
Exactly. But the more critical move was securing contract extensions for 3 rigs, and these came with much, much better payment terms.
Let's drill into those terms because this is the detail that really matters.
It is. So under the new deals, their operating costs get reimbursed on fixed 45-day terms.
Which is incredibly fast for this industry.
Lightning fast. And then the rest of the payment, the bareboat charter fee, that's capped at 180 days of exposure. So their maximum risk per rig is now legally capped at $6 6 months.
So they've put a hard ceiling on their financial risk. It can't spiral out of control like it did before.
Precisely. The end result is that only one rig still has that direct payment exposure to Pemex. The others are either working for big IOCs or they're under these new fortified contracts.
And we're already seeing the cash come in from this.
We are. They collected somewhere between $19 and $27 million in back payments in September and October alone. It shows the new structure is working.
Okay, so they fix one crisis, then another one hits.
Right. In October, international sanctions suddenly forced them to terminate 2 rig contracts, the Odin and the Hild.
This could have been a disaster. A sudden drop in utilization, investors getting spooked.
It could have been. But instead, management showed this incredible commercial agility.
They moved so fast.
Unbelievably fast. The Odin rig immediately got a letter of award for a 6-month job in the U.S. Gulf of Mexico.
Which is a huge deal. That's Borr's entry into a really key market.
A key high-margin market. So they swapped a high-risk contract for a high-quality one. At the same time, the grid rig moves from Mexico all the way to West Africa.
Chasing the best contracts in Angola and Congo.
Yep. And they even managed to pull forward a contract with Shell in Nigeria for the Nat rig. It's now starting in April 2026 instead of late 2026.
So the takeaway here is that their rigs are in such high demand that even with a sudden shock like sanctions, they can backfill that work almost immediately. It's real-world proof of that 97% utilization.
Right. The market is just that tight for these premium assets.
Now, before we get to the macro picture, let's just nail down management's message on capital allocation. It was crystal clear.
It was unambiguous. Deleveraging is the top priority. Period.
They are completely focused on strengthening the balance sheet, getting their debt metrics in order before they even think about refinancing their 2028 bonds.
M&A, shareholder returns, all of that was explicitly put in the for another day category.
Which creates a really interesting setup for investors, something we'll get to in a minute. For now, it's all about discipline.
Total discipline. They're not chasing size for the sake of size. They even said they're skeptical that many new build rigs will actually hit the market because of cost and complexity.
Which just makes their existing young premium fleet even more valuable.
Exactly. Scarcity value.
Okay, let's zoom out to that broader industry context, because this is what gives them the confidence to make these moves. They basically declare that the jackup market has bottomed.
They did. And their timing is really interesting. They see some choppiness in the first half of 2026, as all these rigs are moving around the globe.
Right, the transition period.
But then they expect a much stronger second half of the year.
And the main catalyst for that is the Middle East.
It's Saudi Aramco. They're calling back 7 to 8 rigs that were previously suspended. These are modern, high-spec rigs that are ready to go to work tomorrow.
They're pulling 8 rigs out of the available supply pool at once.
Yeah.
That's a huge deal.
It tightens the market instantly. And that's happening at the same time that you have these big multi-year tenders moving forward in Kuwait and the neutral zone.
So you have this massive demand pull concentrated in one region.
A region that doesn't have enough rigs to satisfy it, which means rigs are going to have to mobilize from other parts of the world, from Asia, from West Africa to meet that demand.
Sucking capacity out of every other market globally.
And you can already see the pressure in the global numbers. As we said, modern jackup utilization is already sitting at about 93%.
So there's only a tiny 7% window of available rigs left, and the whole world is about to start bidding for them.
It gives a company like Borr just tremendous leverage.
We also heard them talk on the call about rising demand for natural gas.
Yeah, this is a newer structural driver.
Okay.
The need for power, especially for things like data centers, is driving a ton of new shallow water gas projects.
In places like Congo, Southeast Asia.
Exactly. And the tool you need for those projects is a jackup rig. So you've got the traditional oil demand tightening supply, and now you have this new gas demand adding another layer on top. It's a powerful combination.
All right, so to recap, exceptional Q3 numbers. They've de-risked Mexico, showed incredible agility with the sanctioned rigs, and the macro outlook is pointing straight up.
Okay, so I think it's about that time.
Right. The part where we have to say, look, we're diving into the data here, but we absolutely do not have a crystal ball.
And we have to be super clear.
This is not financial advice.
Okay. So despite all this good news, the execution, the de-risking the market is still pretty skeptical. The stock's a 1-year laggard, price targets are cautious.
And that skepticism all comes down to one thing, the timeline. The market believes management when they say no shareholder returns until they get closer to that 2028 debt refinancing.
Right. So here's the outrageous but plausible pitch. The market is pricing in zero chance of M&A or buybacks until 2028. But what if they're wrong about the timeline?
What if the cash flow comes in way faster than anyone expects?
Exactly. What if the combination of the Mexico fix and that Saudi-led market tightening means Borr's free cash flow just explodes in late 2025 and 2026?
If that day rate inflection really hits hard in the second half of 2026, they could be sitting on a mountain of excess cash years ahead of schedule.
At that point, telling your shareholders they have to wait until 2028 for any kind of return, that starts to look irresponsible. The sheer amount of cash generation might just force their hand much, much sooner.
So the trade idea is a bet on that timeline accelerating.
It is. The idea would be to look at something like out-of-the-money call options expiring mid-2026, maybe targeting a strike around $4.50 or $5.
You're betting on a big re-rating of the stock. A re-rating based on the market waking up and realizing, wow, the balance sheet is clean and a capital return announcement is coming way sooner than we thought.
It's a bet on an acceleration of both cash flow and sentiment, but all the catalysts are there. The Saudi callbacks, the normalized Mexico operations, and that super high utilization rate.
Okay, to wrap this deep dive up, the key takeaway for me is that Borr just handled every single challenge this quarter flawlessly.
They did. Mexico payment risk, sanctions. They restructured their portfolio on the fly and used the high quality of their fleet to grab even better work in new markets like the U.S. Gulf.
And the whole time, the broader market was turning in their favor, with Aramco tightening the screws on global supply. They are just perfectly positioned for what's coming.
I agree. They are exceptionally well positioned.
So here's a final thought for you to take away. If the global market is already at 93% utilization for modern rigs, before this big demand wave from the Middle East really hits in the second half of 2026, just how high could day rates go for that last 7% of available capacity?
The leverage is shifting, and for a premium operator like Borr, that leverage is going to translate directly into margins.
As always, remember that everything discussed here is purely for informational purposes.
And it is not investment advice. Thank you for joining us for this deep dive.